Hi everyone! So today I'm not covering a Chinese stock directly, but China is still at the center of the story. Because today we are looking at Prosus. Prosus is a listed investment company built around its Tencent stake. Yet it still trades at a discount to its underlying value. So the question is simple. Is that discount an opportunity or is it justified? In this video, I'm not going to cover every single asset inside Prosus. I want to focus on the main listed companies first, because that is where a large part of the value sits, and it is also the easiest place to start. But before going through those names one by one, we need to step back and look at the portfolio as a whole. And when you do that, one thing stands out immediately. Prosus is still overwhelmingly driven by Tencent. On the latest official NAV snapshot dated 1 April 2026, total asset value stands at $174 billion, and Tencent alone accounts for $131 billion of that, so roughly 3/4 of the total. After that, the rest is much smaller, with Europe at $17.4 billion, Latin America at $10 billion, India at $7.3 billion, and other at $8.3 billion. So yes, Prosus is more diversified than a pure Tencent wrapper, but today it's still very clearly the asset that drives the overall story. And once you look beyond Tencent, the rest of the portfolio becomes easier to understand. What you really have is a set of regional digital businesses built around a few recurring activities: food delivery, payments, classifieds, e-commerce, and travel. In Latin America, the main engine is iFood, with Despegar on the travel side and OLX Brazil in classifieds. In Europe, you have Just Eat Takeaway in food delivery, OLX and La Centrale in classified, eMAG in e-commerce, and EasyCo in payments. And in India, the key asset is PayU in payments and fintech, alongside a broader group of stakes linked to delivery, mobility, commerce, and travel. So once you put Tencent aside for a moment, what is left is not just a random list of investments. It is a broader portfolio of digital platforms spread mainly across Latin America, Europe, and India. Now, I'm not going to redo a full Tencent analysis here, because I already made a dedicated video on the company. So if you haven't seen that one yet, I'd encourage you to watch it first. Here, I just want to focus on the latest update, because since that video, Tencent has published its Q4 and full year 2025 results. On revenue, the quarter was strong. Q4 2025 revenue came in at 194.4 billion RMB, up 13% year-on-year, and full year revenue reached 751.8 billion RMB, up 14%. Growth was broad-based, games were strong again, advertising was strong, and fintech plus business services also kept growing. Profitability also kept improving. Q4 EBITDA was 77.1 billion RMB, which implies a margin of roughly 40%, versus about 37% a year earlier. So the trend on margins still looks good. EPS was solid as well. Q4 basic EPS was 6.4 RMB, up about 15% year-on-year. So earnings were still growing faster than revenue, which is usually what you want to see. Now, the one area where investors became a bit more cautious was AI spending and CapEx. Full year CapEx was 79.2 billion RMB, up only 3%, so about 10.5% of revenue. By itself, that number was not especially alarming. The real issue was the forward message. Tencent said it spent 18 billion RMB on new AI products in 2025, and that this should more than double in 2026. So the market reaction seems to have been less about the quarter itself, and more about the idea that Tencent is now entering a heavier investment phase, potentially with lower buybacks as a result. Even so, Tencent still looked very strong on cash generation. Full year free cash flow reached 182.6 billion RMB, up 18% year on year. So even with higher AI investment ahead, this is still a company generating a huge amount of cash. I'm also not going to spend much time on Meituan, because I already made a full video on it. The Meituan stake mainly comes from Tencent's distribution in specie of Meituan shares to Tencent shareholders in 2023. So this wasn't the result of a direct, high-conviction investment decision by Prosus in the same way as Tencent itself. If we move to the other important listed names, the picture is more mixed. Delivery Hero has clearly improved a lot operationally. In 2025, it reported strong adjusted EBITDA and a second consecutive year of positive free cash flow. So at the operating level and at the cash flow level, the business now looks much more mature than it did a few years ago. Swiggy is different. Its food delivery business is profitable on an adjusted EBITDA basis, but at group level, it was still not profitable in its latest disclosed results, mainly because quick commerce was still absorbing a lot of investment. So even among the main listed names outside Tencent, you don't have the same level of maturity everywhere. And beyond that, the rest of the listed portfolio is much smaller. So I don't think it makes sense to over-analyze those positions here. That brings us to the hardest part of the Prosus story. Once you move beyond Tencent and a few listed names, a big part of the value sits in unlisted operating businesses. And this is where the analysis becomes much less straightforward. The group now presents the portfolio much more by region than by the old segment buckets. If we start with Latin America, the end core is clearly iFood. At its core, it's a food delivery platform, but it now goes well beyond that, with groceries, pharmaceutical, digital payments through iFood Pago, and credit services for merchants. Around that, Prosus adds Despegar, which is an online travel agency, and OLX Brazil, which is a classifieds marketplace. In India, the key name is PayU. PayU is basically a payments and fintech platform. Online payments for merchants, payment processing infrastructure, and some credit activity as well. Around PayU, Prosus also has exposure to names like Rapido in mobility, Misho in online commerce, and Ixigo in travel. So India is really centered on payments and fintech, with other consumer internet platforms around it. In Europe, the picture is broader. OLX is a classified marketplace, especially strong in verticals like motors, real estate, and jobs. eMAG is an e-commerce platform and retailer in Central and Eastern Europe. Iyzico is a Turkish payment platform that helps merchants accept online payments and manage payment processing. Then you have La Centrale, which is also a classifieds platform focused on cars, and Just Eat Takeaway in food delivery. So here again, the logic is the same. Combine marketplaces e-commerce, payments, and delivery inside one regional ecosystem. So yes, some of these assets clearly look stronger operationally than they did a few years ago, especially iFood, OLX, and eMAG. But for me, this is still the most difficult part of the Prosus story. EBITDA and EBIT have improved, and in some cases turned positive. But that still doesn't tell us clearly whether these businesses are truly profitable at the bottom line. Most of them still looks like businesses in build mode, still investing, still scaling, still trying to deepen their position in their markets. So for now, I mainly see this part of the portfolio as a bet on future value creation. Maybe some of these businesses will end up creating a lot of value for Prosus, but today it is still hard to judge with confidence, because disclosure is limited and the uncertainty is much higher than for the listed assets. To really understand Prosus, we also need to look at capital allocation. At the beginning, Tencent was not just the anchor asset. It was also the financial engine used to build the rest of the portfolio. The big push came around 2021 and 2022, when the group kept adding exposure to food delivery, payments, fintech, and other digital assets. And the balance sheet makes it clear that this expansion was not financed by one source only. Debt went up sharply, especially by 2022, so leverage clearly played a role. But it was not just debt. Tencent was also sending cash back to Prosus through dividends. So the portfolio was built through a mix of debt and Tencent cash flows. Then the strategy became more selective. In 2022 and 2023, Prosus also started cleaning up parts of the portfolio. It exited Avito after deciding to leave Russia, sold OLX Autos, and slowed down external investments. In financial year 2024, management itself said external M&A had fallen sharply versus the financial year 2022 peak, and that the priority had shifted toward profitability and discipline. Then in financial year 2025, the company became more active again, but in a more focused way. It bought Despegar for $1.7 billion, announced the acquisition of Just Eat Takeaway for 4.1 billion euros, and at the same time sold non-core assets like Trip.com, Taz, Udemy, and GPO, while also partially monetizing Swiggy at IPO. So if we try to judge management at this stage, the answer is not completely obvious. Some assets clearly improved a lot operationally, especially iFood, OLX, and to a lesser extent eMAG, but when you zoom out, the group still has not produced simple and undeniable record of value creation outside Tencent. And this is where the NAV chart can be misleading at first glance. If you just look at the raw numbers, NAV goes from $218.6 billion in October 2021 to $166.5 billion in April 2026. And if, over roughly the same period, Tencent's share price goes from about 430.6 Hong Kong dollar to about 489.2 Hong Kong dollar, the first reaction is straightforward. If the main asset is up but total NAV is down, then maybe management destroyed value over those 5 years. But before jumping to that conclusion, it really helps to look at the outstanding shares chart first. You can see that the share count was already going down before the special operation, which reflects the first buyback programs. Then in September 2023, there is the huge jump. That wasn't normal dilution, and it wasn't a classic capital raise either. It came from the unwind of an Asper's Prosus cross-holding structure. So that spike is mechanical, it is a restructuring effect, not a destruction of value for shareholders. And after that, the line starts falling again as the buybacks continue. And this is also where the financing story becomes much clearer. The buyback program that really matters for the current Prosus story started in June 2022, and Prosus has been very explicit about how it works. The group regularly sells small numbers of Tencent shares and uses that cash to buy back Prosus shares. So the key point is simple. The buybacks were mainly financed by selling part of Tencent. And that is one of the reasons why you cannot just compare the raw NAV line from 2021 to 2026 without adjusting for what happened both to the share base and to the Tencent stake. Once you have that in mind, the adjusted NAV chart becomes much more useful. The reported NAV line is a grey line, and that is the one that falls from $218.6 billion to $166.5 billion. But once the series is adjusted for the 2023 share count distortion and for the effect of the buyback mechanics, the picture changes a lot. The adjusted line goes from about $188.1 billion in October 2021 to about $245.3 billion in February 2026. So on that adjusted basis, NAV didn't fall over the period. It actually increased by about 30%. And that adjusted increase is also clearly stronger than the move in Tencent itself. Tencent's share price rose by about 13.6% between October 2021 and April 2026, while the adjusted NAV line rose by roughly 30% over that same broad period. So this doesn't really look like a clean case of management destroying value. That still doesn't prove that every investment outside Tencent was a success, but it doesn't show that the raw reported NAV line is too misleading on its own. So if I try to sum up this part, my conclusion is fairly conservative. Prosus used its original Tencent investment to build a much broader portfolio, first with debt and Tencent dividends, and later with some Tencent share sales as well. But today, I still don't think it's possible to say clearly that this diversification has been a major success. The reason is simple. A large part of a non-Tencent portfolio is still unlisted, so the value is much harder to verify. In other words, I don't think management has obviously destroyed capital, but I also don't think the success of these investments has really been proven yet. For that, you will need clearer monetization events, disposals, IPOs, or strong recurring cash generation that really validates the carrying value of these assets. And that also helps explain the discount. A holding company like Prosus is almost never going to trade exactly at the value of its portfolio. There is almost always some discounts, because investors have to trust management, accept capital allocation risk, and live with the holding company structure itself. And when a large part of a portfolio is unlisted, that discount becomes even harder to close, simply because the market has less visibility on what those assets are really worth. One thing to keep in mind here is the 2023 special operation. So when you see the share price going from 66.5 euros in June 2023 to 28.1 euros in September 2023, that shouldn't be read like a normal price collapse, because the capital structure changed at that point. Beyond that, the message of the chart is pretty simple. Prosus almost always trades at a large discount to NAV. In 2022, when Tencent was already under heavy pressure, the discount widened to 54.8%. That was a period of maximum fear around Chinese tech and regulation. So investors were clearly not willing to give much credit to a holding company built around Tencent. After that, the discount narrowed, but it still stayed large. Most of the time since then, it has moved in a range of roughly 30% to 42%. And at the end of March 2026, the stock was still trading at 41.4% discount to NAV per share. And this is exactly why the discount can also be an opportunity. Because if Tencent is still the main asset in the portfolio, then selling a small number of Tencent shares to repurchase Prosus stock at a large discount is positive for the shareholders who stay in. As long as the gap between the market price and NAV remains wide, that kind of buyback is mechanically accretive. So overall, the interesting part with Prosus is quite simple. At today's price, buying Prosus is still mainly a way to get exposure to Tencent at a discount. Tencent represents roughly 3/4 of the portfolio, and with the stock trading around 39 euros, the market is giving very little value to the rest of the businesses. So if your goal is to get Tencent exposure with an extra margin of safety, Prosus can make sense. But that doesn't mean the stock is risk-free. A large part of the non-Tencent portfolio is still unlisted, disclosure is limited, and management can still make poor capital allocation decisions or overpay for acquisitions. So for me, this is not the kind of stock you buy without a large discount. You need a real margin of safety, and a little more than 40% discount to NAV probably gives you that today. There is also a second point in favor of the stock. As long as the discount remains very wide, selling a small number of Tencent shares to buy back Prosus stock is still an accretive operation for continuing shareholders. So the discount is not just a sign of market skepticism, it can also become part of a value creation mechanism. And one last thing to keep in mind is the dividend. Prosus is a Dutch company, so the tax treatment can differ from owning Tencent directly, depending on your jurisdiction. But in practice, I don't think that changes much here, because the dividend is small and clearly not the heart of the investment case. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe and share.